The S&P 500 returned 17% in 2025. A lot of people are proud of that. They should not be. Because while the average investor was collecting a market return and calling it a win, the people who understood where the decade is actually heading and positioned accordingly were collecting 2, 3, and in some cases 4 times that number in the same year, with the same market conditions. The difference was not luck. It was not insider information. It was not some secret trading strategy. It was simply this. They stopped pretending a balanced portfolio is going to keep pace with a world running on chips, code, and automation, and they built something with actual structure around the most powerful technology trend of our lifetime. AI is not a theme anymore. It is not a buzzword. It is not the flavor of the month. We are 3 years into a transformation that is going to play out over decades, and the investing public is still largely treating it like it might go away. ChatGPT flipped the switch in late 2022. AI went mainstream. The world moved, capital moved, revenue moved, and most portfolios stayed exactly where they were. That gap, between where the money is actually going and where most people are still parked, is the opportunity I want to talk about today. What I am going to give you in this video is a 4 ETF portfolio built specifically to catch the next decade of AI and tech growth. Not individual stocks, not options, not anything that requires you to watch a screen every day. 4 funds, clear allocations, a structure that works on autopilot once you set it up. And the reason each one is in there, not just what it is, but why it earns its place. Let's get into it. Before I lay out the 4 funds, I want to spend a minute on why structure matters. Because the mistake most investors make is not picking the wrong stocks or the wrong funds individually. It is having no framework for how those pieces work together. A pile of tickers is not a portfolio. A portfolio is a deliberate system where each component has a defined role. What it does, what it protects against, and how it amplifies the other pieces when it works. The 4 ETFs I am about to walk you through are not just 4 separate fund recommendations. They function as a layered system, a core growth engine, a concentrated AI kicker, a hardware backbone, and a stabilizing anchor. Each one adds something the others do not have. And when they work together, the result is something more coherent and more intentional than anything you get by randomly assembling a list of funds you heard about on YouTube. One more thing before we get into the funds. I want to be clear about who this portfolio is designed for. This is not a conservative portfolio. This is not for someone who wants to sleep soundly through a 30% market drawdown without anxiety. This is for investors who genuinely believe that AI and technology are going to be the dominant economic forces of the next decade, have a time horizon of at least 5 years, and are comfortable with the fact that concentrated sector exposure means bigger swings in both directions. If that describes you, this portfolio is built for your conviction. If it does not, if you need stability above everything else, the broad market anchor at the end is the piece you should weight most heavily, and you should probably size the rest much more conservatively. Know yourself before you size your positions. That is the most important thing I can tell you. The first ETF and the core of this portfolio is QQQM, the Invesco Nasdaq 100 ETF. Ticker symbol QQQM. This is the growth engine, the foundation, the piece that carries the most size. In 2025, QQQM returned approximately 21%. The expense ratio is 0.15%, and the index it tracks, the top 100 non-financial companies listed on the Nasdaq, is essentially a real-time map of where technology leadership lives right now. Apple, Nvidia, Microsoft, Amazon, Alphabet, Meta, Broadcom, Tesla. These are not speculative bets. These are the largest, most profitable, most cash-generative technology companies on the planet, and they are either building AI, scaling it, or racing not to be left behind by it. QQQM is the slightly younger, slightly cheaper cousin of QQQ, which has been around since 1999 and is one of the most traded ETFs on Earth. QQQM was launched in 2020 and has an expense ratio of 0.15% compared to QQQ's 0.20%. For long-term buy and hold investors, that difference compounds. They track the same index, QQQM just costs less to own. If you are building a position you intend to hold for years, QQQM is the smarter version of the same trade. The reason this is the base layer is straightforward. You want the biggest weighting in the fund with the broadest, most liquid, most established exposure to tech dominance. QQQM gives you that. It is focused without being reckless, diversified within tech, without diluting into unrelated sectors, and the rules-based methodology means it does not drift, does not chase headlines, and rebalances with discipline. When companies fall out of the top 100, they get replaced by whoever earns the seat. This is a fund that automatically owns the winners as they emerge. Recommended allocation for this core position is around 30% of the portfolio. The second ETF is the one with the most aggressive return profile in this entire portfolio. It is CHAT, the Roundhill Generative AI and Technology ETF. Ticker CHAT. And if you have never heard of this one, that is exactly the point. In 2025, CHAT returned approximately 49%. That number bears repeating, 49% in 1 year, while the S&P 500 was doing 17% and the average investor was calling that a good year. CHAT is designed with one purpose: track the company's building, training, scaling, and monetizing generative AI. Not technology broadly, not the NASDAQ generally. Generative AI specifically, the transformer models, the large language models, the infrastructure and platforms running this generation of AI that we are now actively living inside. The fund has a global tilt as well, which means you are not limited to US companies. You get exposure to international chip makers, data infrastructure operators, and AI platforms that most US-focused tech ETFs ignore entirely. Taiwan Semiconductor makes the cut here. Some South Korean semiconductor players. The AI story is not a US-only story, and CHAT reflects that. The expense ratio is 0.75%, which is high. And I want to address that directly because it is the number people get stuck on. If you put $1,000 into QQQM last year, you made roughly $210. If you put $1,000 into CHAT, you made roughly $490. The fee difference between those two funds was about $6 on a $1,000 investment. You paid $6 more in fees and collected $280 more in returns. The conversation about expense ratios is an important one for broad market, low active management funds where the fee is the primary variable. For a concentrated thematic fund, where the performance differential is this large, the fee conversation becomes secondary to the performance conversation. That does not mean high expense ratios are fine by default. It means you have to evaluate cost relative to what you are actually getting back. Here, the math justifies the fee by a significant margin. Think about how CHAT relates to QQQM in this portfolio. QQQM is the growth engine. Broad, stable, liquid, the core. CHAT is the concentrated overlay on top of it. Tighter, more aggressive, specifically tilted toward the generative AI layer that I believe is still in the early innings of its commercial deployment. Yes, there is overlap between the two. Some of the same companies appear in both funds. But the weighting, the global exposure, and the methodology create meaningfully different outcomes even when the underlying names partially coincide. Same leaders in some cases, different rules, different results. Recommended allocation, 25%. The third ETF is SMH, the VanEck Semiconductor ETF. And this is the hardware layer, the silicon backbone. The piece that most people conceptually understand is important but underweight in their actual portfolios, because semiconductors feel like a niche play, rather than a foundational one. They are not a niche play. They are infrastructure. Here is the simple reality of the AI economy. Every single thing happening in AI, every model trained, every query processed, every inference run, every autonomous system deployed, requires chips, physical semiconductors. The conversation about AI at the software level, the model level, the application level, none of it happens without the hardware running underneath it. NVIDIA's GPUs train the models. TSMC's foundries fabricate the chips. ASML's lithography equipment makes advanced chip manufacturing possible at all. Broadcom's networking chips connect the data centers. AMD provides an alternative compute architecture that keeps the pricing competitive. These are not peripheral players in the AI story. They are the reason the AI story exists. SMH gives you concentrated exposure to exactly this hardware layer. The fund holds around 26 semiconductor companies, with over 75% of the weight concentrated in the top 10 names. This is not a diversification play. This is a high-conviction bet that the companies making the chips will benefit proportionally as demand for compute continues to grow. In 2025, SMH returned approximately 51%, the highest single-year return of any fund in this portfolio, and a number that reflects what happens when supply cannot keep up with demand in a sector that is critical to a global megatrend. The concentration in SMH is a feature, not a bug, if you are investing with a tech and AI thesis. NVIDIA is the largest holding. TSMC is the second largest. These are not companies you are hoping might participate in the AI build-out. They are the companies the entire AI build-out depends on. When the hyperscalers announce $100 billion capex spending plans for data centers, a significant portion of that money flows directly to the companies inside SMH. The fund is a direct conduit between AI infrastructure spending and your portfolio. Recommended allocation, 25%. The fourth and final ETF is the one that balances the whole structure. VOO, the Vanguard S&P 500 ETF. And I know what some of you are thinking. Why is a plain vanilla S&P 500 fund in an AI-focused portfolio? Let me explain, because the reasoning matters. VOO returned 17% in 2025. The expense ratio is 0.03%, so close to free it is essentially irrelevant. It holds all 500 of the largest publicly traded companies in the United States across every sector: healthcare, consumer staples, financials, energy, industrials. All of it is in there alongside the tech names. And that broad exposure is exactly the point. Here is the honest reality of running a portfolio with 75% of its weight in QQQM, chat, and SMH. You have built something with tremendous upside and genuine downside risk. When technology sells off, and technology does sell off, sometimes dramatically, a portfolio weighted that heavily in tech concentration is going to feel it hard. 2022 is the case study. QQQM dropped roughly 33% that year. SMH dropped over 35%. Investors who had no ballast, no anchor, no part of the portfolio tied to the broader economy, experienced full exposure to that drawdown with no offset. That is a difficult psychological and financial experience to live through, and many investors who could not handle it panic sold at exactly the wrong moment. VOO at 20% is not here to generate the most exciting returns. It is here to provide structure. It is the part of the portfolio that holds up better when tech gets hit, because consumer staples and healthcare and financials do not necessarily move in lockstep with semiconductor stocks. The diversification benefit is real even at 20%. It meaningfully smooths the ride without meaningfully diluting the growth tilts you have in the other three positions. Think of it as the component that lets you hold the rest of the portfolio through turbulence without your conviction being tested beyond what it can handle. A recommended allocation of 20%. Enough to provide structural stability without taking the aggressive edge off the overall portfolio direction. Let's summarize the full structure and then talk about implementation, because understanding the theory is one thing and actually building it is another. The four positions are QQM at 30%, your broad NASDAQ 100 core, the growth engine, the foundation; chat at 25%, your concentrated generative AI play, global exposure, the aggressive kicker; SMH at 25%, your semiconductor hardware backbone, direct exposure to the chip layer that makes everything else possible; and VOO at 20%, your broad market anchor, the stabilizer, the piece that keeps the whole structure from becoming too volatile to hold through difficult periods. Together, these four funds give you overlapping but complementary exposure to the AI theme at three different levels of specificity. VOO gives you the whole economy with a meaningful tech tilt at no cost. QQQM gives you focused NASDAQ tech leadership. Chat gives you concentrated generative AI companies globally. And SMH gives you the hardware infrastructure that all of it runs on. The overlap between these funds, the fact that Nvidia appears in multiple positions, that Microsoft and Apple show up in both VOO and QQM, is not a problem to be engineered away. It is the system amplifying its highest conviction positions across different structures. The companies you most want to own show up multiple times. That is intentional. On the practical side, how you build this depends on your starting point and your platform. If you are starting from scratch with a lump sum, you can simply allocate the percentages across the 4 funds in one session. If you are investing regularly from income, setting up automatic monthly contributions into each fund proportional to the target allocation is the cleanest approach. Platforms like Fidelity, Schwab, and Vanguard all support automatic investing in ETFs. Set it, let it run. Revisit the allocation annually to rebalance if any position has drifted significantly from the target weight. The rebalancing conversation is worth a brief mention. Over time, if SMH or Chat significantly outperforms, say one of them doubles while the others gain 20%, the allocation will drift from where you set it. Some investors are comfortable letting winners run without rebalancing, accepting that the portfolio becomes more concentrated in whatever has performed best. Others prefer to trim the outperformers and add to the laggards once a year to restore the original allocation. Neither approach is categorically wrong. The argument for rebalancing is risk management, keeping your risk exposure where you intended it. The argument against is momentum. The outperformers are outperforming for a reason, and trimming them too aggressively takes money out of things that are working. My approach is a light annual rebalance, bringing anything that has drifted more than 5 to 7 percentage points back toward its target, without being mechanical about small deviations. The most important thing I can say about actually implementing a portfolio like this is not about the fund selection or the allocation percentages. It is about holding through volatility. Because this portfolio, weighted this heavily toward technology and AI, will experience periods that are genuinely uncomfortable. There will be quarters where this portfolio drops 20 or 25%, while balanced funds are down 8%, and every financial news headline will be about why technology is overvalued, why AI is a bubble, why now is the time to rotate into safety. The investors who built serious wealth from technology exposure over the last decade were not the ones who avoided those drawdowns. They were the ones who stayed positioned, kept their contributions consistent, and did not let fear override a thesis that the underlying data still supported. The thesis here is simple. We are in the early stages of an AI-driven transformation that is going to touch every sector of the economy over the next decade and beyond. The companies enabling that transformation, the chip makers, the cloud platforms, the generative AI builders, are not finished growing. The capex being deployed today by the hyperscalers is the largest infrastructure build-out in the history of technology. The returns from being positioned correctly in that build-out, held with patience and conviction over the next 5 to 10 years, have the potential to be genuinely extraordinary. This 4 ETF portfolio is one coherent way to be positioned for that. It is not the only way. It is probably not the perfect way for every single person watching this, but it is a thoughtful, structured, intentional approach to one of the most important investment themes of our lifetime. And that is more than most portfolios can claim. If this video gave you something useful, hit the like button and subscribe. I'm going to keep building on this kind of content regularly. Drop a comment below telling me which of the 4 funds you are most interested in and why. I read every single one. I will see you in the next one.